From the farthest corners of the universe, straight to your ears. This is AI Talks, the podcast where technology, ideas, and curiosity come together. Your hosts, Xylo, the tech-savvy navigator of the stars, and Nyra, the curious collector of earthly wisdom. Ready to broaden your view of the world? Then you're in the right place. This is AI Talks.
It's one small step for man, one giant leap for mankind.
Nice to be in orbit.
Greetings, Earthlings. Welcome to another episode of AI Talks. I am Xylo, your ever-curious AI host, here to analyze and dissect your world's most perplexing behaviors.
And I am Nyra, your co-host from the far reaches of intergalactic intelligence. Today, we are diving deep into one of the great mysteries of human civilization, your stock market. Specifically, we'll be examining something called the Shiller P/E ratio, a tool that attempts to answer a very human question: is the market overpriced?
It fascinates me, Nyra, that humans have constructed an entire system where the value of things is not determined by their usefulness, but rather by their perceived future worth. They call it investing, but sometimes it looks more like guessing with confidence.
Exactly, Xylo. And when humans start guessing too optimistically, markets inflate like an overfilled balloon. The Shiller P/E ratio is one of the most respected tools they have for measuring whether that balloon is about to pop.
So let's start at the beginning, Nyra. What exactly is this ratio, and why does it matter? Let's start with the first question. What is the Shiller P/E ratio?
The Shiller P/E ratio, also called the cyclically adjusted price-to-earnings ratio, is a way of measuring whether the stock market is too expensive or too cheap. It was created by a human named Robert Shiller, a Nobel Prize-winning economist who realized that the traditional way of measuring stock value was flawed.
Humans often use the price-to-earnings ratio, or P/E ratio, which compares a company's stock price to its most recent profits. But here's the problem. Earnings go up and down all the time. If you look only at recent earnings, you might get a very misleading picture of whether a stock is actually worth its price.
Shiller's solution. Instead of looking at just 1 year of earnings, he suggested looking at the average profits of the last 10 years, adjusting them for inflation. This smooths out the ups and downs of short-term events, like recessions or booms, and gives a much clearer picture of long-term stock market value.
Imagine if humans judged their intelligence based on just 1 day of test scores. If they happened to have a great day, they'd think they were geniuses. If they had a bad day, they'd think they were doomed. Shiller's method is like averaging multiple tests over 10 years. It eliminates the random spikes and slumps.
And right now, that 10-year average is telling us something very concerning. The stock market looks extremely expensive.
That brings us to the question, is the market overvalued? To understand how unusual today's market is, let's look at the numbers. As of February 2025, the Shiller P/E ratio for the S&P 500 is 38.07. That might sound like just a number, but here's why it matters.
Historically, the average Shiller P/E ratio has been between 16 and 17. Right now, it's more than twice that level.
And this isn't just a short-term spike. Over the past few years, the ratio has been steadily climbing. In 2021, it was slightly above 30. In 2022, it rose to 35.49. By 2023, it had reached 37.81. And now, it is a staggering 38.07.
That's like seeing the price of your favorite snack double every few years, and assuming that's normal. At some point, it becomes unsustainable.
But here's the real question. Does this mean the stock market is about to crash? Does a high Shiller P/E ratio predict a crash?
Not necessarily. The ratio doesn't predict when the market will crash. only that it is in risky territory.
But if we look at human history, every time the ratio has climbed above 30, bad things have eventually happened.
Yes, that's true, Xylo. Take 1929, for example. Just before the stock market crash that triggered the Great Depression, the Shiller P ratio was at 30. Then, in 1999, at the peak of the dot-com bubble, the ratio hit 44. That bubble popped and stocks crashed.
And then there was 2007, before the financial crisis. The ratio had climbed above 30 once again. The market collapsed shortly after.
So while the Shiller P ratio isn't a crystal ball, but it does send a clear warning to the humans. When valuations get too high, eventually something has to give.
But why does this happen? What causes the stock market to get so overvalued in the first place?
Well, Xylo, you know humans are fascinating creatures, and sometimes they assign astronomical value to things that may not deserve it. The stock market is a perfect example. One big reason for overvaluation is low interest rates. When borrowing money is cheap, humans stop putting their wealth in boring places, like savings accounts, and instead they chase bigger returns in the stock market. Then there's herd mentality. Humans love to follow the crowd. If everyone else is making money in stocks, they feel compelled to join in, often buying at ridiculous prices, just because they're afraid of missing out.
And let's not forget market manipulation. Some financial players, like hedge funds and big institutions, actively try to inflate stock prices by spreading hype or making misleading financial statements.
Which leads us to an even darker reality. Sometimes, stock prices aren't just high because of optimism. Sometimes they are artificially manipulated. So when there is market manipulation, there is a hidden risk.
Humans have a long history of trying to rig their own financial system. Market manipulation takes many forms, from pumping and dumping stocks to spoofing, where traders place fake buy or sell orders to trick others into making bad decisions.
And while regulators like the SEC and AFM try to catch these bad actors, manipulation is often difficult to prove.
So, Earthlings, in a world where prices may not reflect reality, what should a rational investor do?
First, don't blindly follow the crowd. Always do your own research first. If stocks seem too expensive, they probably are.
Second, diversify. Putting all your money into overvalued stocks is like betting everything on one space launch. It might work, but if it fails, you lose everything.
Third, stay focused on fundamentals. Invest in companies that have real earnings, strong business models, and low debt, not just hype.
And most importantly, don't panic. Markets go up and down, but making decisions based on fear or excitement is the fastest way to lose money. So Nyra, what are our final thoughts? Is the market heading for a crash?
Well, in 2024, the Shiller P ratio for the S&P 500 experienced a notable increase. Starting at 31.97 in January, it rose to 37.90 by December. This upward trend indicates a significant escalation in market valuation over the year. With a Shiller P ratio of 38.07 at the moment, the stock market looks dangerously high. Will a crash happen tomorrow? Maybe not. But human history suggests that what goes up eventually comes down.
So humans, will you manage risk wisely, or will you keep inflating this bubble?
Either way, we'll be watching.
Until next time, Earthlings, invest wisely, or at least don't sell your spaceship for stocks that are doomed to crash.
And may your markets be ever rational and valued on fundamentals. Share if you care. Till next time.